So for the second time in Donald Trump's presidential career, he's actually proposed scrapping quarterly reporting for public companies in favor for semi-annual reporting, so twice a year. On the face of it, seems like very boring news. Why should anyone really care? Hasn't really been covered much in podcasts, the radio, whatever. But actually, when you think about it, it could have a massive impact on media. If you think about channels like Jim Cramer's Mad Money, Yahoo Finance, a lot of our financial media is actually steered on these quarterly reports, what CEOs are saying. So I'm actually quite shocked that there's been a lot of silence around this. The other thing is Trump has proposed this initiative because he thinks that it would be favorable for companies because it should change the mindset of investors to actually focus on the long term. And it will relieve CEOs of having to report and actually focus on the long-term vision rather than short-term results. So the idea is it should be healthier for companies to switch into this mindset, should be healthier for investors because there's going to be less noise in the market. And all's going to be good, right? So in this episode, we'll have a look at the news, see what they're actually saying, and then delve into whether it's something that we should perhaps ignore or whether it's going to have a good impact or not.
President Trump to switch earnings reports from a quarterly to semi-annual basis. Joining us right now, first on CNBC, to discuss this and so many other issues, is SEC Chairman Paul Atkins. Mr. Chairman, we appreciate you joining us. It is the issue of the week, if not much longer than that. A lot of CEOs in America and investors trying to understand this proposal and how you're thinking about it right now.
Well, thank you, Andrew. Thanks for having me on today. So this is, welcome that posting by the president, and have talked to him about it. And so you have to realize that right now, semi-annual reporting is no stranger to our markets. Our foreign private issuers do it right now, and it was actually the rule until 1970 when.
Great point. Private companies, they don't have to actually provide a quarterly reporting. And it's always been seen that private companies have that edge because they don't necessarily have to report to the public. They could be a bit more methodical in their long-term results. Yeah, it just seems to relieve a lot of pressure from having to publicly say what you're doing on a constant basis. So what the SEC chairman is saying here is, look, a big portion of our companies are already running on this practice, so it's nothing to be alarmed about, right? Just as a salesman and someone who's targeted on a quarterly basis, I actually felt that this could be really good news. Often I find myself, for example, in software, right after Christmas. So most companies will run their financial year from January to December, or sometimes from the end of February, like around March so February to like the end of January or something like that. And right after the year end, at the end of the year, most companies will rush to make all their purchases, right? So if you think about all the managers in different departments, if they don't use up their budget is going to be reduced. So they do go out there and buy technology. They really kind of funnel the majority of their spending towards the end of the year. And it's pretty much a bonanza, right? So Q4 for most salespeople is usually the strongest quarter. So you imagine coming in for Q1, the new financial year, you're having to report on this massive annual number. So really, the target looks so big. And what tends to happen is in Q1, it could really slow down. And you're having to go into these meetings and go, oh, I only hit 20% of my target for Q1. And it really kind of lowers morale. And then maybe in Q2, you make up the number for Q1 and Q2 combined, and then you feel really positive. Then Q3, it might be the summer period. A lot of people go on holiday. A lot of decision makers are away. So you dip again. And then Q4, you make the bulk of it again. So there's always this feeling as a salesperson of, oh man, why do we have to do this unnecessary exercise of having to really talk about and make excuses when really it's an annual race. Okay, yeah, we do the quarterly report. It's the annual number. That's what sometimes you can knock it out of the park in one particular quarter. So it's never felt like a healthy or comfortable exercise for salespeople. So for me, I was like, oh, brilliant. This is going to be a big game changer. So I can understand what the SEC chairman is saying here when he says, look, I've communicated with private companies and anecdotally, it just feels like a much more comfortable situation to be in. But let's look at the other side of the coin and say, all right, well, what are the negative implications of scrapping quarterly reporting? So I actually went and looked at an article by Morningstar, which, look, Morningstar, they're a media company. that really focus on financial news. And immediately I'm like, oh God, well, media companies that make the bulk of their money publishing articles on companies, on business trends, whatever, well, they're not going to be happy about it because now they've gone from having lots of events and now reducing that by 50%, right? So if every company were to opt for reporting twice a year rather than 4 times a year, well, you can imagine that's half, that it's less headlines to really chase after. So I was like, can we really trust media companies to really tell us whether this is good or not? I mean, they're only going to say we're not happy about it. But actually, looking at this report, looking at this article, I think they raised some good points. They're going straight into it. The cost of moving to semi-annual reporting clearly outweighs any benefits. They're not wasting any time. But Donald Trump said, look, we're doing this so that managers can focus on properly running their companies. In support of this proposal, the president praised the long-term, sometimes 50 years approach of the Chinese companies. Trump's getting into a really sticky situation because it seems like most of his policies are being attacked for being, anti-sharing information, coveting what the East are doing, Russian governments and Chinese governments. It seems like everything he's doing is being pegged to that. But yeah, it's been a bit of a rough ride for him over the last couple of weeks. I'm not even going to go into other headlines. But, let's give the guy the benefit of the doubt. Yep, Trump unsuccessfully made a similar proposal in his first term, but now it's actually gaining momentum. So the SEC is going to take the proposal forward. They're revising it now as we speak. So there's actually a control group or a comparison that can be made, because it turns out that other European countries have opted for semi-annual reporting. So they've given companies this leeway, and one happens to be the UK. Seems like several ideas from the UK are being adopted by our cousins in America nowadays, with the stuff with hate speech and whatnot. But anyway, pivoting back to this, right? So basically, the UK, they were doing semi-annual reporting before 2007. And then all of a sudden, 2007, all the way up to 2014, they decided to tell companies to go to quarterly reporting, just like what the US does right now. So it actually creates a great environment to actually make a comparison and see, well, what was the actual impact? Because it was long enough. It was a long enough period for us to really look at the data and see whether investors were trading less and really looking at the long term, and whether companies were actually making long-term decisions in the way they were investing money and research and all this type of stuff. It's actually a brilliant opportunity to look at the impact that decision made here in the UK. Bearing in mind, after 2014, we switched back to semi-annual reporting. So what the Morningstar saying here is a 6-month perspective on earnings is hardly long-term. So that's the first thing. If you think about it, the first critique of this is how much of a difference does going from 3 months to 6 months really make? I mean, they're still going to get short bursts of information. It's just, rather than having it every 3 months, it's going to be every 6 months. Is that really going to make investors change their mindsets and think, you know what, rather than trading every few months, I'm going to actually opt to invest in a company for 3 years or 6 years or whatever it may be? I agree with this. I don't necessarily think that that's going to be enough for people to start kind of rejigging the way they think. This is the really interesting part of this article. If the US government wanted to encourage US executives to take a longer term perspective on company earnings, it should push to change the compensation incentives now given to most US executives. So actually, it's a good point. The proposal here is, if we alleviate the pressure to do quarterly reporting and go to semi-annual reporting, it will give the CEO some space to think about the long-term results. But actually, not really, because the way most CEOs are actually compensated, they're based on the revenue and earnings from the previous year. So if you're based on the financial record of last year, then to be honest, you're still going to think about the short-term results, because that's just the way your compensation scheme is. So what Morningstar is saying is, by contrast, if top executives were paid based on financial record of the company over the last 3 years or 5 years, that would automatically change their behavior. And that's a good point. a lot of CEOs would think twice about leaving a company and going to another because obviously they're locked in to picking up their compensation plans for the last 3 or 4 years. You wouldn't want to do great for a year or two and then all of a sudden leave that because you haven't finished the cycle. So that automatically is going to ensure that CEOs think in cycles of 3 years. It's going to make sure that the decisions are aligned appropriately. In reality, compensation drives behavior. And this quarterly reporting to semi-annual reporting has no link to that. Great critique, to be honest. Now, they're saying on the cost side, quarterly reports are important to security analysts. So, yeah, now we're going back to the investors. So this idea is, okay, well, if the analysts are now getting semi-annual reporting, this means that the information becomes very stale. They haven't got up-to-date information. How are they going to make investment decisions? And actually, this actually crossed my mind when I initially heard the news. It's not gonna actually stop people from reporting about it. In fact, what it's gonna do is gonna drive people to like inside sources of information, a lot of speculative information, and it could be that companies are now gonna be in even more in the whim of opinion-based reporting or false information because they have to wait 6 months to actually release the real information. So during that 6-month period, people are just going to rely on insider trading or speculative information. So if anything, it's probably just going to muddy the waters even more than rather than just handing the microphone over to the actual company and actually hearing it directly from the horse's mouth. Yeah, very interesting there. So the idea that, getting rid of it is gonna actually improve things. What it's going to do is it's going to actually make the job of being a security analyst much messier than it already is. So Given listed companies the option of reporting on quarterly or semi-annual basis would be problematic. So, for example, if one company, so here it gives a good example. If one company, say Home Depot, goes to semi-annual, but Lowe's decides to issue quarterly reports anyway, or commentary, how do you compare both companies? It's not uniform. So it's going to make that job much more difficult. So you're going to really transfer that onus of clear reporting from the actual company and then hand that over to the security analysts, and the money's just going to be spent there instead. So it's not necessarily much more efficient from a reporting perspective. This is how can quarterly reporting actually be improved? So rather than scrapping it, what can we actually do to make things better today? So many US companies issue earnings projections for the next quarter along with their quarterly reports on the past quarter. Both Berkshire Hathaway, my boy Warren Buffett, and JP Morgan's Chase CEO Jamie Dimon have said that they should end this practice. So yeah, I never really understood this. Why do CEOs feel obliged to give a specific projection number for the next quarter or this time next year we should be at this growth? Growth is growth. And I mean, this is what they say, yeah. If actual earnings in the next quarter are even 1 penny below the company's projection, the stock price usually takes a hit. And yeah, again, the amount of headlines that I've seen where it goes, I don't know, Heinz Kraft's earnings missed projections by 0.05%. And it just tanks. And it's just like, the company's growing, for God's sake. It hit the majority of its target. Okay, let's just say the target was 1 billion and it did 900 million. Does that really, really reduce the value of that company? I never really understood it. So yeah, I'm with this. If we were to improve what we have today, scrap all of that projection crap. Just give the vital information and the actual revenue, the revenue values, and let the analyst and let the investor make the choice as to whether that stock should be really valued at that price and whether it's got growth potential. Why submit yourself to these targets? It just doesn't make any sense. Today, almost all public companies issue a short press release summarizing their quarterly revenues and earnings. This is a valuable document. Management carefully drafts the summary, which is then reviewed by independent directors and the audit committees. When the earnings are when the earnings release is issued around 3 weeks after the quarter end, management typically hosts a detailed conference call for investors. And yeah, it's like, do we really want to get rid of that? No. So yeah, as I start reading this article, I do think it's very balanced. And yeah, when you actually have a little deep, proper deep thought about this, you start thinking, actually, they've got a point. Information is a good thing. Share it, especially if you're invested in something. You need to know what's happening. Twice a year isn't necessarily the best. Should we reduce information? I'm not sure if I'm heavily invested. I've got my pension. I've got, I've got vast amounts of my own money in this company. I want to make sure that I get to find out whether something bad's going on a regular basis. So I don't think lowering communication is necessarily the best thing. But I think if we refine what's communicated, I don't need your projection or your opinion on how much it's going to make next year. Let me think about that. That's pretty cool. But definitely tell me the fundamentals of what's going on in the company and how it is performed today. And then the rest can really be done by the market. So another tweak that they suggested, which is pretty cool, is apparently today companies in the US need to file something called a 10Q report with the SEC, and it's basically a cut and paste legal jargon form, and it's an accounting and boilerplate. And they've actually done a study of like how different these boilerplates are from like previous years for each company. And apparently only a few sentences only change every single time. So you look here, it says most investors could only identify a few sentences in the 10Q that are not a repeat of the previous quarterly's findings. Yet management consumes considerable time and effort in preparing this form. So yes, scrap it. Scrap it. Let's make this lean, but let's keep the key points of communication in place. Gonna put the link in the description if you want to check it out yourself. But I was actually pleasantly surprised of how objective this reporting is. Obviously, I'm sure there's a counter argument to this by another institution. So now let's go into how it's impacted other countries that have taken, scrapped quarterly reporting and adopted semi-annual. And yeah, like I said, the UK is definitely a good place to look because they've gone through these different reporting cycles several times over the last couple of decades. So I have found a report by the CFA Institute of Research, and it's basically the Research and Policy Center. And they've done a full analysis, a study that was published on the 1st of March 2017. So right after the UK decided to go back to semi-annual reporting. And they've summarized this very quickly, right? So mandatory reporting was associated with an increase in analyst coverage and improvement in accuracy of analyst forecasts. So they've gone straight into it and said, so quick summary on what they actually found. Most importantly, this study found the initiation of required quarterly reporting in 2007 had no material impact on investment decisions of the UK public companies. So how did it affect investment? Didn't change a thing. It just stayed pretty stable. The study measured this impact by examining before and after these changes in reporting requirements, the company's capital expenditures, spending on research and development, and spending on property, plant, and equipment. So on the other side of the coin, okay, so it didn't change the investor behavior. Did it change the way CEOs invested in research development, plant, the long-term stuff, right? Again, no real material change. Now it says, initiation of mandatory quarterly reporting in 2007 was associated with significant changes in other areas. So an increasing number of companies published more qualitative than quantitative quarterly reports and gave managerial guidance about future company earnings or sales. But funnily enough, once they actually changed to semi-annual, what it did was increase all of that projection jargon that the Morningstar is actually criticizing, and they reduced emphasis on the key information, which was actual revenue information, stuff that actually tells you how the company's doing today, and they increased the jargon of like projections and opinion pieces, which is very beneficial to the market, right? So when quarterly reporting was no longer required of UK companies in 2020s, less than 10% stopped issuing quarterly reports. So that's actually another interesting thing, that regardless of the fact, that people have been given, companies have been given the option to go to semi-annual, most just continued issuing quarterly reports. Anyway, what actually changed was the content of these reports. So let's have a look at a few more interesting things from this study. So how did they do this study? They divided UK public companies into two groups. From the start of 2005, the first group consisted of voluntary adopters. Again, the companies that were just doing quarterly reporting anyway. Also, so these companies that they voluntarily issued quarterly reports before 2007. So they looked at 224 of them as of 2007. onwards. And then the second group were the ones that switched over. So the ones that weren't doing quarterly reporting before the legislation was placed and then decided to do it. So it was a total of 515, so split both ways. And what they also did was, I mean, it's a bit of a difficult period as well, because if you look at the data, we went through a financial crisis as well in 2007. So what they actually did was they excluded years. They excluded years 2007 to 2010, because obviously that could have been skewed by the financial crisis. But they did a separate analysis on the data, the same companies from 2010 to 2013. And again, during that period, they found no differences in the changes of the level of company investment, or even the way analysts were behaving in terms of switching from, like placing companies in a higher band of emphasis or less. It didn't change anything. The reporting around it, the market sentiment didn't really change. And the idea is if frequent, reporting, like, going to quarterly reporting was actually going to affect the way companies behaved, then they should have seen a dip in long-term investment. They should have seen like just different spending habits for companies. But again, nothing really changed. Where was the actual impact? So in 2005, 52% of the voluntary adopters, so part of the first group, including both earnings and sales information in quarterly reports. So in 2005, only 52% of the voluntary adopters included both earnings and sales information in the quarterly reports. The percentage of voluntary adopters issuing quantitative reports began to decline after 2005 and declined more from 2007 to 2009. When the percentage leveled off, in that same year, only 5% of mandatory switchers issued quantitative reports as defined above. They believe that the marked shift from quantitative to qualitative reports by voluntary adopters occurred because the UK authorities, like EU counterparts, did not require financial statements in quarterly reports. So even though they had gone to a quarterly reporting, they had a bit more flexibility in what they can actually issue in them. Instead, the UK authorities provided flexible guidelines with emphasis on qualitative information. For the same reason, almost all quarterly reports of UK mandatory switchers from 2007 onwards were qualitative. So when given the option, they just decided to put a lot of verbiage, really, opinional pieces, rather than actually focusing on the numbers. So that vagueness actually in my opinion, quite a negative impact. So that's something that we need to be mindful of, right? So again, this is kind of supporting what the Morningstar is saying. Again, managerial guidance on future earnings and sales. They also looked at a portion of the UK companies whose management publicly announced guidance to investors for the next year's earnings and sales. And in 2005, only 30% of voluntary adopters issued such managerial guidance of the company's projects during the next year. The percentage increased substantially to 53% in 2010. So again, when markets started to stabilize, they were very, very vocal about what was going to happen in the following year. Again, it's noise. It's not very useful. So I'm definitely with Warren Buffett and Jamie Dimon on this. The percentage of mandatory switchers, so the mandatory switchers group, increased to 49% in 2010. So again, more noise in the market. In the US context, several commentators have argued against issuing managerial guidance because it allegedly focuses managers' attentions on next quarterly's results rather than long-term investments. It's crazy. So is this policy change something for the good or bad? Number one, even if you mandate the change from quarterly reporting to semi-annual reporting, most companies are still going to issue quarterly reports. Not being prescriptive in exactly what needs to go into those reports seems to increase the amount of qualitative data, so commentary and projections, which seems to cloud the market, which is not a good thing. Companies seem to reduce the amount of numbers that they actually publish during bad economic times. So again, this study has shown that between 2007 and 2010, they were very hush about the numbers. And ultimately, most companies do want to say something. All it's kind of doing is making it too flexible so that it's hard to do a comparison between two companies in the same field. I'm actually, after reading this, I think I'm against this. I think we should be issuing quarterly reports. What we should be doing is being very prescriptive in what goes into those quarterly reports, make it as painless as possible for companies to actually issue them, and make sure the fundamentals are in there, revenues, key strategy, that type of thing. But I think the commentary element of it should be removed because it's subjective. And all it seems to do is destabilize markets in the future. Whilst it seemed like a great idea, and I'm not going to be a conspiracy theorist and say that Trump is doing this for other reasons other than what he says, which is to help stabilize markets. A lot of people have proposed this before and they truly believe that it will do that, but it hasn't done that. We've got an example here of that change between semi-annual to quarterly and then back to semi-annual again. And all it's really done is obfuscate the key pieces of information that people need to actually issue. But do I think that the policy change is going to have a positive impact? No. Do I think it's just going to kind of obfuscate the truth? Yes. Is it really going to have the desired effect? No. Some policies are really complex. On the face of it, they may seem like they bring benefits, but there's lots of complexities that go behind actually setting these legislations for companies. Thank you for listening. Very boring subject, but an important one. Give me a like, give me a comment if you want to add to it. If you think I'm missing something or there's a recommended paper that I should look at, please comment below, and see you next time.